Oh, good day. How you going? It's Phil Tarrant here, co-host of Inside Commercial Property. Hope you're well. Joined in the studio live Wednesday afternoon. Scott O'Neill, director, founder, Rethink Investing. Scott, how you going?
I'm well.
Good,
How
mate.
are you, Phil?
All right, mate. We're streaming across the airwaves. That is the Property Investment Podcast Network. You're probably also watching us or tuning into us on the YouTube or the Instagram. I know you're a big Instagrammer. You're always walking around with your shirt off.
You keep
Sorry.
saying that, mate. Now I'm all self-conscious.
I know. I can't help it, mate.
Keep those photos away.
Well, I was going to say, the rig might look good sometimes, but maybe what's inside isn't that good. And a lot can be said. A lot can be said as a metaphor for property investment, particularly commercial property right now. It might look good. The bones might be right. It might be nice to look at, but deep down, it might not be a good asset.
Yeah, it's a great intro, and I thought today would be a good day to just talk about when things go wrong. You know, like there's a lot of good stories out there, and I think it's important to share them, especially when things are mostly negative bias towards commercial out there. So we've covered that really well. But yeah, I was going to just share some stories. I've traveled around and bought and been involved in thousands of transactions. So and seen many more that I'm not part of as well. So yeah, just going through some of the things and lessons learnt, really.
Yeah, and it's good. We've been recording this podcast now. It's hugely popular, by the way. I think in many ways it's shaped a lot of people's decisions around investing. Probably it's funny. I was, and you may be tuning into this, and you'll know who you are. I was at my local bottle shop buying a bottle of wine while I was waiting for my takeaway to cook the take home on I can't remember what day it was, but there was a really nice lady behind me, and she was also buying the said bottle of wine. She went, I went, oh look, yeah, here you go. Well, he goes, oh, how's your podcast going? And I was like, oh, really? What podcast? She goes, oh, yeah, the commercial one. So there's listeners all over the place, mate. And I don't like the fact that I'm so recognisable these days. It makes me a bit nervous. But I think a lot of people, and thank you for the very positive sentiment around the podcast. If you are tuning into this, but I reckon a lot of people have shaped their decision making around what they invest in and where because of what we've been talking about on this podcast for a couple of years now. That's really, really cool. However, we need to acknowledge the significance of that and the responsibility we have around it as well. It's not all beer and skittles investing in commercial property, and we've spoken about a lot of the positives of investing in commercial versus potentially resi investment or other asset classes, but we really need to highlight the fact that not everyone gets it right. A lot of people get it wrong. A lot of people get it really wrong. Hopefully by tuning in this, you can try and mitigate where it does go wrong, but getting it wrong in commercial property investment isn't necessarily always about poor yields, right? It can go horrifically wrong if you get it really wrong.
Exactly. And one of the things I get asked when I go onto a different podcast, it's like a real entry level type intro into commercial. Is like they go, tell me the pros and cons, residential versus commercial, that kind of dialogue. And you normally just start with, oh yeah, vacancies are longer. I always say, the risks are higher, the rewards are higher too. Residential, you can know very little about what you're doing, but you've got that common sense touch because you live in a house. You can kind of understand people will rent a house because you understand living in a house. But commercial, you will get punished more if you make a bad call. And I think we can delve into that rather than just say it like a high level thing, which is pretty much what the media talks about. So we can tell you what that actually means and things I've seen out there. And there's lots of examples. You could talk for many hours, but there's solutions for most of this stuff too. So that's the key. Like if you are in one of these situations, if you've overpaid for a property or you've got a tenant that's bailed on you or a baited up lease, like there are solutions. So we can sort of step by step through.
Yeah, let's do that. And I don't want to beat this up too much. I don't want us to be the merchants of doom and gloom and negativity, right? But you will find that a lot of people's perceptions towards commercial property has probably shifted quite a lot in the last 6 months because the yields you were getting on super low interest rates are probably very different to the yields you're getting right now. And, we've spoken about it at length. Most people who have been investing in commercial property, if they've been taken on debt 70%, are probably still cash flow positive. But I reckon there's a lot of people getting pretty close to the line on good assets into not negative territory, but neutral territory in terms of the gap between what you pay for your mortgage versus what income you get and everything else around it. So that is like things not going as well as what they used to, but that's very different to things going fundamentally wrong. And chatting to you offline, there's some people who have really got it wrong recently. Maybe that's where we start. What really wrong looks like.
Yeah, so the ones that are the classic example of going wrong is overpaying for a property and not knowing you've overpaid for it. So I'll give you an example, and this was bought by a property professional. So it was a buyer's agency, one of those ones that sort of do resi mostly, and they've sort of had a crack at commercial, and it was a Anytime Fitness. I'm not going to say the location, but call it Southeast Queensland. I remember seeing it because it was online for a while. It was about a 3 mil purchase, 7.5 year lease on it. Looked great. Yield was 7%. The rest of the market at the time was about 6. So I was tempted. I looked at it, and immediately you go, wow, that rent looks high per square meter. It was about 350 a square meter, but comparables were less than 250, 220 to be fair. Someone ended up buying. I just walked at that point. I went, well, that's too much risk. The vow wouldn't stack up. That was my immediate thought. Not worth the hassle, even if the tenant was good. Within 2 months of settlement, this tenant left. And I only looked at, I was just looking at old ads, and I saw there was a vacant lease ad. And I went, oh, surely that was the Fitness First, but sorry, the Anytime Fitness. And it was gone. So I calculated this person involved would have probably overpaid by a mil, 1.2 to 3 mil overpaid for it.
Overpaid in terms of the asset purchase.
Yeah, just because of the rent, and now it's vacant, so it could be even less. But it's only going to be worth less until you replace the tenant. But you're not going to replace it at that same rent level. So it's a dud, unfortunately, just due to overpaying. So fortunately, they're quite easy to see. So as a trained professional, even if you don't know what you're doing, the first lesson is always check the rent square meter rates. Like you may remember, Phil, the first thing we looked at when we're looking at your property had a list of comparable rentals, and you could see your one was under rented, and that de-risks it. That stops that situation happening. And it's harder than you think, because if you buy a childcare, how do you work out the comparable rents? Like, it starts to get a little bit more clouded depending on the asset class and depending on the fit out. Our KFC's paying the fair rent. Coles and Woolworths all have sort of set rates off turnover amounts as well. So it can be a lot more tricky than you think. But high level, just make sure you check the square meter rate, because you don't want to be that guy that loses $1 million for a dodgy tenant.
So that's like apples for apples, right? Like that's where you can actually compare, what the rent should be versus what it currently is on the lease. And if there's a gap, north or south of that, it's a question mark.
Yeah. And one of the things about residential is it's hard to do that. It's hard to make a mistake that bad, because you can kind of just look at what others are selling on the street, and even if you don't even understand general mathematics, you can get it. But commercial, these types of scenarios are quite common, especially like with little cafes and stuff like that, where their uncle's related, and they pump the rent up because they know they're going to get a quick sale. They don't care if they lose their bond and get chased for money, because you're probably not going to catch them in many cases.
So that's really wrong, would you say, or that's pretty good wrong?
That's about as bad as it gets.
Okay.
Like it's because it's hard to fix that.
It's really hard to fix it. So the issue was that, number one, the tenant was paying too much for the comparable rent he was paying was too much versus what he should be paying, which probably put cash flow constraints on his business, which means he couldn't pay the bills and therefore probably went bust.
Yeah.
Or the rent was overinflated for the purpose of selling the asset to someone.
Could have been both.
Could have been both.
And you never know this. And the longer I do this game, it's even when you just don't know what happens behind closed doors.
Yeah.
What handshake agreements have been done? Like, have they not disclosed how bad a business is going until after settlement? The classic example is maintenance. You get a builder out, and he might know the owner, or like we had the one. This is another little gotcha type of thing. Air conditionings. We see after settlement, all of a sudden the big 10 grand bill comes in. So I get many calls from clients going, Scott, why didn't we find this bill out? And we got a builder out to check it. We even got an aircon specialist, and they mysteriously don't find the issue until after settlement. It's like, how convenient.
Yeah. And they know they're going to get a check from someone else, right? To pay to fix it. you've got to sit there and just go, oh, is it really that murky? Is it really that? Is that many people with the wrong intent and has skullduggery who's going to try and stitch you up, trying to flog you a commercial property? But back to this, is it Anytime Fitness, was it?
Yeah.
Anytime Fitness. So what's a recourse on the tenant with that? If he just goes, I'm out of here, if it's a 7-year lease, he's still got to pay the rent for 7 years, right?
Yeah, he filed bankruptcy. He was an individual operator. He lost his bond.
So the worst for him is he lost his bond, he's bankrupt, and he can't do anything for a little while. But
we can, well, we're not involved in that sale whatsoever. But the buyer could try chase this guy
in the courts, which is.
But if he doesn't have money, and like he was, because I actually spoke to the agent, like, because I always find that stuff interesting because you want to learn from it. And, it was all like blaming COVID and all that kind of stuff for it. But at the end of the day, the rent was way too high.
When was the purchase? Do you remember?
It was early last year. And then it all failed sort of before mid last year, really. Okay.
So it's COVID impacted.
Would have been.
You would have to argue there's probably a pretty good COVID impacted. But who's buying gyms in the middle of COVID, right?
Well, yeah, I actually didn't mind the gym scenario because, like, gyms, I always have a long-term picture. Like, we were talking every month during COVID, and I like the actual benefit we got out of COVID. We got the gyms at better prices because everyone was going, "Oh, gyms are dead forever." Good gyms are all up and running and going as strong as ever, really. I'm more worried about the extra competition they're going to get from other competing gyms. That's more of an issue. COVID was always going to come and go, But yeah, if you've got a 7-year lease and you can't afford the rent, that's fatal.
You see this F45 is going to the wall, right? Which it was just a business for selling franchises. And there's a lot of people who kind of blow their dough on that. And most of those S45s are in smaller, 200 square meter, mum and dad type investments, right? I'd like to know how many people have invested in locations which has an F45 in it, and whether or not they're getting their rent check each month.
Yeah. Oh, exactly. And think about what their competitive advantage is. So think like Anytime Fitness. A lot of the other big gyms are going 24 hours now. So their model, like, I'm not in the gym industry. I've got no idea how it goes, but common sense tells you they're going to have more threats than potentially, I don't know, a World Gym or, one of the big boys who offer, a slightly different product, a more wholesome, or, basically just
it's hard to have a point of difference in gyms these days, right?
Yeah.
They can only have the next gimmick, right? Which might be F25 or, I reckon a good idea for a gym is just fill a gym full of dirt and gravel and like clay and just give people pickaxes and spades and just go dig holes. If you want a gym, go and do that sort of stuff. Anyway,
next momentum media.
There you go. Yeah, the next venture. So that's going pretty bad, right? So how do you remedy this? You've either got to reset the rent to a place and a point where you can and the big question around who owns the fit out also, right? That's another big issue.
So to fix something like that, the best, or just problem solving, you go, how can I get the same rent? Well, you're going to probably have to split it up. So you look at maybe trying to get smaller tenancies going. I'd run multiple ads. So you do one for the whole size, and then look if it makes sense to split it twice or 3 times, have individual smaller ads. That's what, a lot of the big guys like Center Group do. They just have, sizes between X, Y, and Z, and just try to get different tenants in. Whoever comes first, just take them. That's what I do, and just get it on the market. Leasing is going to be harder at different times of year. So leasing right now is not good. If you're like, we're in November now, it's gonna be tough to find a tenant before Christmas. So leasing activity generally starts kicking up mid-February. So if you can kind of string a previous tenant along for a few extra months, get them over that Christmas hurdle, it's definitely a smart option. But you just got to be a little bit careful trying to go before Christmas, because the vacancies will last, and then your ad gets a little stale.
So how let's just say, for example, it's 300 square meter gym, right? Which is probably maybe about right. And it's got to have dunnies and all that sort of stuff in the services. If you go, okay, I'm going to turn into 3 100 square meter shops, whatever it might look like, homewares, a hairdresser, whatever else you want to do. Like, there's a fair bit of work to split that up, right? Like, you can market it saying this is what you can do, and you can And if you get a bite on that and someone goes, yeah, I want one of them or I want two of them, you're going to go and start doing the work. But to actually do the fit out works on that with services, different meters, different plumbing capabilities, you start messing around with that and you got to start complying to different rules which have come in. Like you might need to put disabled toilets in, all that sort of stuff. Things can get really pricey, right? If you start changing things up.
Yeah, definitely. And you just got to remember in these dark times, if you're going through this, like it's probably a 1 in a 10-year type event. Like I was talking to someone the other day about the whole vacancies. When you deal with residential, you might have 4 weeks vacancy every year. So over a 10-year period, you're getting 40 weeks cumulative total. So commercial, your tenant will generally stay 5, 10, 15 years. So let's say you're lucky, you get them for 10 years and you've got 3-4 months vacancy. Overall, it's almost the same as residential. It's just all in one hit.
Yeah.
And human nature will make you, if you're a panicker and you've seen 3 months of no inquiries and ads, it does not feel good. If you've gone through it before, you probably don't care too much. It's just all part and parcel because, once you land that tenant, you might have them for the next decade. So you just got to remember a lot of it's just mindset. You just spend the money if you have to, if you can. If you don't, you just got to leave it as is and just get lucky on the market. It's not a bad time to lease a property. At the moment, the vacancy rates are tightening, even for office at the moment, but industrial's as tight as it possibly can. And
Mate, you say that. I was just down in one of those Banger Towers, International Tower number 3, like an hour or so ago. And I looked out at International Tower number 2. Most people know the towers I'm talking about down in Banger in the in Sydney. And mate, I counted about 20 floors with no one in it. There was just workstations with not a body on it, no lights on. And I was sitting there going, God, you've got these organizations blowing a lot of money on rent in these places where no one is. And then you've got obviously the carbon footprint around, if you want to get sort of environmental around it all, with these offices which are there and no one's in them or they're still burning power. But then the asset manager, the asset owner is collecting rent on this stuff, right? With no occupancy, and that can't last forever, right? Like it's concerning.
And this is probably another possible what could go wrong with commercial. So that's a really good point. These towers are generally owned by REITs, real estate investment trust.
Can you just explain what that is for our listeners that don't know what a REIT is?
It's basically a giant formal syndicate run with an AFSL, Australian Financial Service License. A lot of them are listed on the stock exchange, like Stockland, Centuria, all those types of big companies. Now, the issue they're going to have in the next 5 years is remember they promise 5, 6, 7% returns, cash on cash. So that's not that great.
To the investors in the REITs.
Yep. Now the interest rate rises have come up.
And super funds are owned. If you've got super, you've probably got a lot of it money tucked away in something like this, by the way.
Yep.
A retail or industry fund.
Now the risk I see with this model is they rely on very bullish and regular valuations, and they're top heavy at the moment because they've kind of assumed these high occupancy rates, like you're mentioning, you can see them, they're not actually occupied, and they've kind of valued it as it's completely full of people, and they're at sharp cap rates, and also they're not really promising great returns versus the risk now. So there's potentially more people not wanting to invest, so it's going to be harder to fuel that moving forward until there's either a lot of rent growth, but it can't happen when vacancies are high. Industrial will be different. Neighborhood shopping centers will be different, but these office towers, like how can you keep pushing rents up when vacancy rates are high? Plus I saw numerous cranes in the sky still, so they're still building more supply. I just think there's headwinds for these big companies. Like the valuations are not matching what they should be on the ground potentially.
And the issue is that the people who are impacted by that, you have direct investors in REITs, but your super funds are the institutional money is what's propping up a lot of these large real estate investment plays. So guess what? Aussies aren't getting a return on their super if they've maxed out inside of, or they've got a particular fund that spends a lot of money inside of these type of products. So maybe it's time to look at a self-managed super fund. Do it yourself. Buy a residential shopping centre, right?
Yeah, I think controlling it yourself is a much better option. And my main reason for it is that there's less fees. So when you put money into a Australian real estate investment trust, there might be a 1 or 2% acquisitions fee at the start, and then there might be an annual 1% or 0.5%. And they normally sell the asset every 7 years. So you've got 7 years of that 1% plus a 2% up front. So you're up to 9% fees and then a selling fee. So you lose 10% of your investment in fees on the whole asset value. And then on top of that, they clip you for 25% of the profits, the capital gains. So you lose another 25% of whatever the upside was. So,
and this is your investment manager creaming it. They're the ones driving Ferraris, right?
yeah, and that's why some of these investment companies they're as big as small banks, and I think if you set up your own little small syndicate where you're not, exposed to that level of fees, it's okay. But yeah, I'm just basically saying the bad side of that industry is the fees. And but look, it's a safe investment, or was safe when the valuation stacked up. But what I say, like, it's not all doom and gloom. Like, this is a moment in time again. If interest rates drop next year, all of a sudden those vows are completely justified again, and the show goes on. So that's sort of what has always happened, except for the GFC, but they were more highly leveraged back then, these funds. So they're a lot more conservatively weighted these days.
So by leverage, you mean for our listeners that there was a lot more debt involved in the funds. Now there's less debt.
Yeah, as a percentage of the
total asset value. Yeah. Which means if it all goes wrong, it doesn't go as wrong.
Yeah.
Yeah.
So if you've got a low leverage syndicate, you're probably looking okay at the moment. Highly leveraged ones, it's not as good.
Which means there's a lot of debt you're paying, right? And if your rents aren't as strong as what they are and your debt repayments going up, it's...
Yeah. And if they're relying on the VAL to be 5-10% higher next year
to reprice it to keep their debt at a reasonable level,
it's going to be hard for them.
Yeah, there you go. Well, there's lots of moving parts there. That's more so getting into insto commercial property acquisitions and largely, this podcast for, not institutional money, it's for private money. It's that people sort of doing it themselves or inside a super fund or small little tie up when people club up and create their own syndicate to buy commercial property. So you're giving us one example of it going wrong, like wrong. What have you got something like that you see all the time, which is just not, it's an asset not performing very well. You might not realize it. Maybe you can answer that to my original point, Scott, which was commercial property doesn't look as good today as what it did 6 months ago. And a lot of people will be thinking this. How do you sort of calibrate that? Again, you're going to say it's just a moment in time, no doubt, but how do you calibrate that?
Well, it doesn't look as good, and no asset class does at the moment, because it basically interest rates are causing the cost of money is going up, so your margins are going to be thinner. So it's not good for business. It's not good for people buying their first residential property. It's not good for anyone. But it's getting, hopefully, it'll get the inflation under control, because that's not good either. And that inflation has caused huge issues. The most noticeable one you'll notice is if you get an insurance bill this year versus next year, they're all going up like 20, 30, 40%. So that actually eats your margin away if you're on a gross lease, or your poor tenant's going to cop a massive bill.
Yeah.
Instead of it being 15 grand, it might be 25, 30,000 this year. So that you could imagine talking to your tenant, say, oh, look, sorry, you're on a net lease. You pay all my outgoings, but fortunately insurance has gone up, and we see this every day. Every time we buy a property, the owner goes, oh, that insurance you got's overquoted. You should talk to my guy. He'll get you a better deal. But it's a underinsured property, which, he's missed the building replacement value, and it's a dodgy insurance bill that won't even pay you out. So to do it properly, it's going to cost more. And that's a management issue more so, but you won't you've got a strata cost, but your strata will go up next year for your tenants in your property, because the insurance is probably going to go up 30, 40%.
Yeah. And that's, and you think about this as if you're a tenant in commercial property versus an investor in commercial property, of which I'm both. If you're a tenant, you want to do deals where you just pay a percentage of the increase in the outgoings rather than a percentage of the outgoings, right? Like that's when you baseline, that's when you negotiate hard at the front of it. But there will be a lot of people who are buying commercial assets with leases like that in it. So even though there's a big jump in the quantum of these regular payments, you could probably only garnish a little bit of it from the actual tenant. You're going to get hit, right? And which makes your commercial investment look even worse than what it currently does. So the point I made was that, and I think about the property that we use as an example on this show, Scott, the one that you guys helped me buy out in Perth, was about $1 million. I think it put 40 grand in my back pocket every month. Every year. When it all washed through, that's a very different number now, rather than being 2.5 grand a month interest repayment. It's like $4,700 now, right? So it's eroding it quickly.
Yep.
So do I just go, yeah, it's just the way it's going to be for a little while. It's not costing me yet. I'm still positive rather than negative, but what needs to happen for that to become a negative asset? So by the way, that asset sits inside my super fund, where my superannuation contributions need to start paying for the upkeep of a current property I have. So I'm essentially going backwards.
Yeah. So look, if rates got to say 8, because you put cash down in that deal, you'd need your rates to be about 9% for that to be negative. If that happens, I think we've got bigger problems than, and you still wouldn't sell because it'd probably be the one property just treading along, but all the others will be massively negative. And, I think this is a time you just buckle down, get through the next, 6, 12 months, whatever it is, because what we're seeing now is actually worse on the tenants than the owners. Like sure, our margins are gone, instead of making ridiculous money on the cash flow, you're now making modest. And a lot of this is going to get passed back onto your tenants, and whether it's a natural CPI increase or because one of the risks we're seeing as well is if you've got a big long lease and it's only on a 2.5 or 3% increase, it means you don't have the opportunity to increase your rents, because rents are growing at, in some areas, 10, 15, 20% in some certain subsectors. So you want to have the ability to change the rent on the tenant, because that will get your margin back into it. And the longer this all happens, the better it is. Like we're not looking at the P&Ls just for this year, because they're not going to be as good as they were last year. But again, it's like the tide just slowly comes in. Those rents will keep creeping up. Your leverage will, stay the same. Your asset value will go up every time the rent goes up. So, don't think there's going to be less people retire this year, because you need to keep the income source.
And you just need to accept that, because it's the market that's done it. It's not yourself, right?
Yeah. And we've all lived through markets like this before. It's a different type. I was a lot more fearful in the early days of COVID, because I felt rents were dropping. I thought the tenants wouldn't have the ability to pay the rent. For me as an investor, that was scary. This is, I'm very comfortable, because I can see the tenants in general en masse paying their rent.
I don't know why you were worried about. You own Kentucky Fried Chickens, mate. They went through the roof, right? When COVID happened, there was more people. The only thing you could do to get out of your house was to go and get food, right? Down to go KFC, get a bucket.
I know. Well, the types of tenants I bought, it changed my investor behavior back. So the tenants I've got a Chemist Warehouse, an Audi, Hungry Jack's, a KFC.
You've got an Audi, have you?
Yeah, in Perth.
Okay.
But they're all these recession type tenants. It doesn't. So, because I always plan for these Armageddon things. You've got to think this. And right now, I've planned for this. I've got my buffers in place, and every investor needs to have that. If you've redlined to get a deal done, it's okay if you've got new cash flow coming in to support it. But if you haven't planned for 7% interest rates and you can't hold through for the next 6, 12 months, then you've probably gone a bit too aggressive. So this is just part of being an investor, and we'll all come out of it. And once the rates start dropping, I think the asset values could surge, and that's because people are going to be feeling like now is the best time to invest. We've got this is the low point, and time to get into a good cash flow asset. Still the best option out there.
Is this a low point, or will it get lower than where we are?
I think Q1. I'm only guessing, but if I'm speculating as an investor, I think Q1, Q2 will be the best buying periods we see in the next 10 years. Because
it's a big call.
It just feels like that, because it's cool right now. It's the last month since we did the last podcast, it's definitely got quieter. That last interest rate, you can feel people's purse strings are tightening.
Yeah.
The first few
I reckon it is as well. You're starting to see it, right? People are starting now to question some spending, right?
And wait till Christmas goes through, everyone's spent on presents and all that kind of stuff, and you're going to feel like people have spent money on Christmas holidays. I think it's going to get tighter. And there's all the tech wipeout at the moment, the Bitcoin wipeout. So there's a lot of wealth that's evaporated in the world in the last month.
Yeah. Well, how do you feel about your portfolio? You currently in love with your portfolio, or is it a bit of a nuisance?
Look, I sat down with the wife late the other night, and we're going, all right, we've got to work out what all the numbers are doing. And it was really frustrating to the point where we've realized so many of the agents are not pushing the rents where they should up. They're not like some rent. We haven't been checking as closely as we should.
Commercial or resi? Resi stuff you got?
To be honest, the commercial has been a bit trickier because a lot of them are new purchases,
Yeah.
and for some reason, we've found a lot of the commercial agents are more stretched. So,
But you can't really affect changes to your commercial rent if you're on a long-term lease, right? You know, you're locked in, right?
they haven't even put certain CPI increases through automatically, or
Oh, they're just missing them.
just totally missing them. And these are big rents. Like, some tenants paying 300-400 grand a year, one tenant, and you just think, oh, that was 4 months ago. What have you been doing?
What are they saying?
They're all same excuses. They just got excuses. So we're actually now.
But you go, hang on a second. You've been able to receive the rent and take your fee from that every month, and you can find time to do that. But you've forgotten to increase mine by the CPI or 4% or whatever it is.
Yeah, it was very frustrating. It was like we were literally just going, "What the hell has been happening?" You know.
And did you think they were good commercial agents before that?
I did. There is like everything. There's sometimes a difference between the really good sales agent in that business and then you're dealing with the rental department,
which is a hard job, to be fair. Like, you know, it's
and they're massively short staffed.
Yeah,
I don't blame them.
Well, I spoke to he's left now, but he was the former president. I think it's the president of the Real Estate Institute of Australia, and he's like, on resi, like they're like 10,000 property managers short of what they need to service what they have right now. Like, you know, that's mad. Like they're really, really short staffed.
And that's the problem, I think. They're like, I ask a question because, you know, we mentioned last podcast looking into things like solar panels. So we want to get the bills from the tenants. You know, we ask the manager, "Oh, get the bill." Another week passes. 3 follow-ups. Where's the bill? Oh, sorry, I haven't got around to it. And you think, just get it.
So this is things going wrong. Really, it's not like wrong.
Yep.
Because it's not like you're blowing your dough, but they're administrative headaches which, number one, negatively frame your attitude towards commercial property investing, which isn't a good thing. And sometimes you go, it's too hard, or it costs you more money because you got to work out how do you fix it. Like you got to pay for someone to do it all.
Yeah.
You know, but that's what you pay the commercial. The irony is that's what you pay the commercial property manager for, to work for you on your behalf.
Yeah.
Yeah.
And look, maybe it's just been a frustrating couple of months because everyone's stretched. Because like one of the things I've always thought about commercial, and it has been true in general, is it's a lot easier to manage because you deal with one lease. It's a business type tenant. It is better, but there's just a lot of change in the industry. Like people are so stretched, and it's a management issue. That's all it is. It's not a money thing, but it will be for us because we've now realized it's probably now time to actually hire someone full time because we've got 54 tenants in amongst our properties, and then some of them are complex tenants with very detailed leases and that. So
that's a lot of tenants, mate.
And we're just going through spreadsheets, and this is not something I want to do with my day-to-day life.
You love spreadsheets. I know you love spreadsheets. You used to love spreadsheets.
Not when it's like, this is the rent and this is what we received, and just trying to like manually audit it.
It's not nice work, right?
No.
And you got to like find stuff, and
yeah,
I hate it. I always put it off, and I just sit there and just go, oh, okay.
So I think bookkeeper time just to sort all that out, because you don't want to be left 20 grand short and never know about it. And that's
probably happening, right? But that's going wrong. You know, that's leakage, right? Like, where's my 20 grand?
Yep.
But so on that basis, then, if you're 20 grand short, someone's received the money somewhere. So is that, you know, or it's just really not the CPI stuff getting involved, the rent increase getting passed on, right? And it's not good for the tenant when they get a bill that says, "Oh yeah, we missed this 6 months ago. You got to pay us back this much money." They're going to go, like, I can't find that money.
Yeah, look, on that note, I have found they are pretty decent because like the legal lease agreement is they've got to pay it. So it's just like admin error, frustration. And but look, they do generally pay. I think if you did it with residential, it's a lot different because there's more of that month-to-month living that you'll get with
Why don't you just sell everything then? Just sell how many 50-something tenants? That's a lot of tenants, mate, in a lot of different locations. Just sell everything.
Well, if you look at what happens,
get rid of the lot. Pay a big tax bill.
Well, this is the good bit. Like we've got about 64 mil in property. So if that grows 10% in the next 2 years, you made 6.4 mil. That's another property you can leverage and then buy a $10 million property for doing nothing. It feeds itself, and that
sounds like a real first world problem you've got there, mate.
But look, you'd know this. Your portfolio, like we spoke a few months ago, like you've got this size where literally you are creating deposits to the point where you don't even care anymore to use them. But that's the beauty of property. You leverage, and I'm a big believer currency is just going to keep devaluing across the world as long as I live. It's just going to get less and less valuable because they keep printing it. There's unlimited supply of it. So you've got to hedge your bets. And I'm done with the stock market as much as I get tempted with everyone's hot tips. But, you think about the buildings all these stock market companies are in, the companies will go and come many times over in decades. Some will last 100 years, but most don't. But the buildings are always there. And I just like that longevity of a good quality building, and it will outlast me. And that's the beauty of it. And you just sort of run at lower debt levels in time. And yeah, that's why you play these games. And that's why thousands of people, it's the way for the middle class to get out of the middle class and retire, I think. It's the only easy way to
Property.
using property, unless you start a business or do something, crazy like that.
And get lucky.
Get lucky.
Get lucky. Well, it's pretty sensible stuff, what you're saying there, mate. You got a big portfolio, right? Most commercial investors, I'm sure there's heaps of family offices that got a lot more of it, but you got a complicated property portfolio that needs love and attention, right? So a lot of people be sitting here listening to you going, "Oh, poor Scott, he's got to look at spreadsheets," right? But this is a podcast for commercial property investors, so most people who tune into this would be going, "Oh, how do I emulate this bloke?" And that's the reason why we do this, because it's not all easy. And property, particularly commercial property, is not a passive investment, particularly if your portfolio gets big, resi or commercial. It becomes less passive and it becomes a full-time job. So you got to work out where's the best way for you to deploy your time, energy, and effort. Is it doing spreadsheets and bookkeeping type work, or is it out there sort of strategically shuffling the decks of your portfolio and working out what's next, keeping connected with the market, doing this sort of stuff, right? And I'd argue that's probably where you need to be. But there is solutions, to your point, to most problems, and most issues you're facing in commercial investing. Is only when things go really wrong that you can be stuck between a rock and a hard place. But typically that's when there's a buyer's agent sitting there in the wings looking to snap up a distressed property, right? And you guys like to operate there as well.
Exactly. And I'm really highlighting the negatives right now. And that and it's because I've probably had more troubles in the last month than we had in the last 3 years. It's just because there's changeover of tenants.
It's cyclical. It always happens like that. It's always like there's no problems, and then it's just like everything is wrong.
Yep. So, our solution is changing managers. At the moment, we're just consolidating the good ones to take over more of our current properties. But we are in the background just going, well, we can't manage this. We don't want the responsibility to have to audit the portfolio, because it is just, it's an accountant's job, and there's no real value we're adding to it besides.
Mate, this sounds horrible, right? I get rental statements, and again, it's a first world problem. And I go, that looks a bit small. I'm talking resi, right? No, even commercial. I get commercial stuff and I go, oh, that's a bit weird. I get resi stuff and I go, that's a lot less than what I think it should be. Like, what's happened here? I've got no idea. And I call them up and they go, oh, yeah, they're putting your hot water system in because of this. And I go, oh, I don't remember that. And they go, well, yeah, we spoke to you about it and you said do it, right? I go, oh, okay, all right, fine. But it goes wrong.
Something that you did, that you told me, which was really good, because your accountant, Munzrel, he told me he went through all your properties and actually did a P&L, like proper, like business statement on it, so you can work out the exact cash flow each of them. So few people do that.
Yeah, you should see my property spreadsheet. Like an accountant would be impressed, and I'm just a journalist, mate.
Yeah. But it's brilliant. Then you can make calls on properties. Go, yeah, that's just been treading water for. It helps you sell properties and not just go, oh, buy and hold forever, because that's not a solution. If you got 200 grand trapped in a dud, get it out and just put it as cash, or go buy a better property somewhere.
Well, it's one of the strategies that I'm doing right now. I'm stacked up in offsets, right? Just waiting for that moment in time that you spoke about, which I completely agree with you. I think there's going to be some pretty good buying late Q3, Q4 of this financial year. So March through to June.
Yep.
So you got money parked in offsets if you've got resi stuff, or even if it's your owner occupier, right? You're not paying any interest on it. You're paying a lot less, right? So you're getting 5% on your money, and it's liquid, sitting there waiting. It's good perpetual energy you can deploy when you're ready in time. So, good luck getting sort of 5% on your money at the moment. Liquid investment, you can spend it tomorrow. That's pretty good going. So if you're not doing that, I'd highly suggest you do it.
Yep,
My view.
exactly. Yeah, and I think that's just advice. Like, do what you've done. You get your accountant to actually run, and I'm trying to get mine the same, because we've been having our own manual spreadsheets, but have an accountant signed off one.
Yeah.
Like a business. Like, that's what we do with our business. Why don't we do it?
Because you might do it yourself, but you might have something wrong in it. You want some boffin who knows what they're doing to. Not that Munzerall's a boffin; he's a very smart guy. But you just want to know the integrity of your visibility on your property investment portfolio is accurate at any given time. Because if it's not, you're stuffed.
And don't forget your depreciation allowances.
Oh God, yeah,
that's hard to put in a spreadsheet, and monitor it, because remember, it devalues over. Like, it's just it needs to be treated properly.
It's got to be treated like a business.
Yeah,
absolutely. So how else do things go wrong, Scott? Are you getting people calling you up? Here's a question for you. And then, to my point, we don't want to be merchants of doom and gloom, but we're conscious that commercial property moves in cycles. Sometimes it's great, sometimes it's less than great. And it's from a yielding point of view, it's a less than great environment now than what it was in a period prior. But are people calling up now clients going, oh, Scott, mate, this isn't as good as what it was a year ago. What's going on? How do you answer that?
In all honesty, we haven't had there's no regrets of buying, zero, because we're all long-term investors. We all know these rates are going up. If anything, it's highlighted the strength of commercial, because it's still positively geared. So to still get that income even after all this, it's we're looking at some of these guys buying $4 or $5 million holiday homes, in the Central Coast and stuff like that. Imagine you've leveraged when the interest rates were 2% off your Sydney property, then buy a $4 million holiday home.
Yeah, which are both going down in value now.
You're losing huge cash flow because your mortgage has gone up 3 times, and you've lost value. Like, that's a horror story.
Well, you've lost value twice, right? Because you've refinanced, you've had heaps of equity in your principal place of residence. You refinanced it maybe up to 80%, and that property's come back 20%.
Yep.
So you're potentially in negative equity on your principal place of residence, and the same thing applies on said second residence, right? Like, that's bad.
Exactly. And this is the key point.
Time will fix it, by the way, if you can hold the line.
Exactly. But the key point is, all these other investments have done a lot worse, including the stock market. Commercial's still, even in these bad times, held its own. It's not flying 10-20% growth like it was, and you're getting 4% margins on the rent versus the interest rate cover. It's tightened it, but it's still a lot better than everything else out there. So we're seeing our investors almost double down in commercial. Like, we're still purchasing 40 a month. That's okay. That's normal.
What sort of stuff are you buying? Tell me about that.
Small shopping centers.
What time? How long we've been going for? About 45 minutes and 50 minutes. Or I want to know about this. Small shopping centers.
So our briefs, the most common, small shopping centers, 3 to 8 mil. That type of stuff. That's for your guys spending a bit more.
Are they cash money buyers or are they leverage buyers?
Generally 40% cash.
Okay.
So they'll 60% lend on those.
And lenders are happy to sort of throw in for that sort of asset?
Every day of the week. They're going so hard for loans because the volumes of commercial banks are lower now. So they're really needing to make quotas. So they're basically going, I'll charge you no application fee. I'll, fight for whatever I can. I'll give you, like, the rates are higher, but there's no other.
So you can shop hard, right? Like, you've got a good broker, shop hard. Right? Which lenders are most interested in commercial lending at the moment? What are you seeing?
Most aggressive out of the majors are NAB and CommBank. I looked at both in my last purchase, and they were literally calling 3 times a day because I started chasing. Yeah, because they knew I told them I was looking at 2 different banks, and they got desperate. It was kind of funny, so I said, "Oh no, keep chipping it away. What's this $5,000 application fee? Get rid of that." And they just wiped everything. And they were like, "All right, we'll look after your other like." They're just
that's completely different song sheet they're singing to. A year ago, they wouldn't want to talk to you. They're like, "Oh,
because their volumes are lower, so they need to make their quota to turn profit." So it's a good sign if the banks are healthy and need your.
And this is the point, though. We're talking about good buying conditions coming up, and there's a reason for that. There's probably 2 sides of it. Number one is supply and demand for commercial properties is probably and valuations have come down, so good time to buy. But also, banks are happy to lend.
Yep.
And you need those two things side by side. But you've got to have the confidence to back Australian business, though, as part of this. Because remember, if you invest in commercial property, you're investing in the prosperity of commercial Australia. So I think the economy's sort of going okay. A lot of inflationary problems and concerns and pressures.
Yeah, the minute you don't invest in property for commercial is when you think that rents are going to drop. That's for me the time to sit out. So right now we've been very positive, saying, yeah, exactly the reasons you mentioned, time to get in. But when you see there's a sharp drop coming in rents, like let's say there's a massive GFC coming up, business is failing, unemployment's going up, sit on the sidelines, because that's not a good time to get in.
So you're not on the sidelines at the moment?
No, the closest I got was in 2020 because we didn't know what was happening.
When we started this podcast.
Yeah, it was a bit nerve-wracking, but the thing that helped was the interest rates were so low that it just made mathematical sense. Like you're getting a 7% yielding property and you're getting a 3% loan. It had to work, and it did. We were right. Like things skyrocketed, and now we're in a different phase. The margins are tighter, but we're in a rent growth phase. So that gives me confidence. At least the next 5 years are going to be good.
So if we're talking about a rent growth phase, and if you have a commercial lease in place, it means it's pegged. Typically, there'll be some sort of option to extend it over time at the commercial rate. So how far before a lease expiring, it might be a 5-year lease, or whatever it is expiring, should you start negotiating on that new lease? Because you might want to punt the tenant, right, if they're not going to come up with the rent which is market.
There's two ways to do it. You just sneak it up on them and just go, oh, your rent's up. Guess what? Here's your market rate. Quick. And they're going to panic and go look around and realize they can't find another lease. But if you're really fearful they're going to actually leave and you need time to plan it, chat with them early. And that will give you the option to potentially put a side ad online, because sometimes that's what you got to do to get the tenant over the line. Go, all right, well, you're not signing this lease. Well, guess what? I'm going to have to put a sign up in front of your property. And that helps sometimes.
And they don't want to see a thing up the front saying for lease. People go, oh, what, the business going bust?
It's calling their bluff. If they're going to move, they're going to move, and that will speed them up. If they're going to stay and they're just trying to play.
The thing is that the same thing applies in Resi. I had a place up in Brizzy and it was way under market rent. I said, what's the market rent? And I sort of pushed it up to where it was, and which was comparatively as a percentage quite a lot. It was maybe a 35-40% increase right in the rent. The tenants went, no, we're leaving. And I went, fine. And we put an avert up, and they looked around and worked out that they're probably getting a good deal, and they went, okay, we decided to stay. It's the same logic, right?
Exactly.
You just got to play the game.
So it's no different. You just got to be a little bit more on the technical comparable sales. So hit them up with a spreadsheet showing this is what all your other neighbours are paying. Because you're not trying to rip anyone off, but you can't be ripped off either.
Yeah, and that's it. It's got to be fair market rent. And if it's fair market rent, that's all okay. Whatever's in the contract is the way it should be. But anyway, that's quite a long podcast. Hope you enjoyed that, everyone. It's good to, I don't want to say it's a contrarian view towards commercial property investment, but it's probably a realistic and practical view today. And as I said at the top end, it's not all beer and Skittles. I don't even know what that's an American term, isn't it? What's the Australian term of that? There's not always a she'll be right. It's not always she'll be right in commercial property.
Yeah,
I don't know.
On the top of
something
list.
like that.
Yeah.
Anyway, thanks, Scott. So what's next for us? We're going to see each other again before the what do you call it? Christmas break and the new year. What do you want to talk about next month?
Probably keen to get. So I might get another guest in.
Okay.
We'll see. Like I've got a lot of people that still want to get on, so maybe that. But if the listeners just want to email through at info@rethinkinvesting.com.au, just topics. Even this topic comes from someone just mentioning, oh yeah, tell us what goes wrong. So we're listening to what you guys are saying, and we can talk for the next 10 years on this type of stuff. So it's good to be targeted, and you guys can help.
Maybe we should get a accountant on at some point, right?
Yeah,
that'd be good. Come on over yarn, see what's going on. Maybe some real estate agents, they give us the real dirt on the trickery that happens inside of commercial leasing.
Someone who wants to, warts and all type stories.
Yeah, we won't video, and we can put a funny voice over them and put that little black thing over their eyes, right? But anyway, go and check these guys out. Rethink Investing, just Google them and you'll track them. Then you guys, can people actually get in front of you before Chrissy? You got capacity?
Yeah, just reach out. Like we're always saying there's a small waiting list, but that's just due to the supply of properties. But you want to talk to us, we can plan next year and Yeah.
Yeah.
Get yourself ready in for this good buying period. That's it'll be around for a while. There's no big rush, and that's the big key. You don't need, like, we've got a lot of people that are quite impatient because they, people want to get into the market, and you're not missing out if you're not in this month.
Yeah.
You get in next month or the month after.
So
Like,
just take it easy, relax, and it'll
yeah,
be okay. But the Chrissy New Year's period is a good time to get your house in order. I always use it to do a bit of a, not really a spring clean because it's the middle of summer, but just sort out all my admin. That's probably gone a bit to the wane over the period. So a good time to do some stuff. Rethink Investing. This is Inside Commercial Property. Hope you enjoyed that. We'll see you again next time. Until then, bye bye.